Everybody, and welcome into this evening's live stream where we will be talking about the AI Supercycle and some Warren Buffett stuff. Man, he's been killing it. How about that? Together with Adam Patty, the CEO and co-founder of Vista Shares. They have multiple ETFs, which we'll be discussing tonight. Super excited to be working with you to get the word out on these, especially in a market environment like this. You've got two different tickers. Of course, AIS is the one that I have been talking about most actively if people have been on some of my spaces, some of the other pieces around there. And then OMAH, little Omaha, piece right there with Warren Buffett. And we'll talk about those as well. Adam, before we get too far into things, would you mind giving a brief introduction to the audience of who you are and your background?
Sure. Well, first of all, thanks for having me, guys. I'm very excited. I've been in the ETF market for a long time. I started in 01, then I started a company in 06 called Index IQ. We focused on liquid alternatives. Built that company up, sold it to New York Life, spent a few years there building out their ETF platform. And then when I left there and was fortunate enough to start Vista Shares just over a year ago.
Very cool. I appreciate it. Wow. That's the most concise, amazing intro filled with a lot of experience that I've ever heard. There's no in between. People go short or long. Very cool. So let's get right into the good stuff here. Let's start. Do you want to start off with AIS or you want to start off with the other one?
Yeah. AI.
All right, perfect. So AIS, this has been out and the movement has been really, obviously right now the market's going all over the place right now. Buying opportunity, one might say, right, within these areas. But you guys have been coming through. You already broke that 10 million AUM mark, which is great, especially with, a market, pulling back like this. Talk to me about how AIS came about. What was the thought process here? And then we'll get into some of what it actually holds.
Yeah, well, as you mentioned, the good news is that AI companies are on sale, apparently after today. So really the way AIS came about, and it's a very different approach to gaining exposure to artificial intelligence stocks. My partner in this company is a guy named John McNeil. John was the president of Tesla. He was the COO of Lyft. He's on the board of General Motors. He's a brilliant businessman and technologist, and he's been involved in AI and autonomous vehicles, really since the beginning. And the way this all came about is he was on CNBC one day being interviewed and talking about AI, and the question to him was, well, how do I gain exposure to this new sector that's so exciting? And he said, well, I'm sure there's an ETF to do that. And he thought, there's a lot of ETFs that do that, but the fact is that they really don't do that. And when he went to look at what was out in the market, he took a look under the hood, looked at the holdings, looked at the methodologies, said, wait a minute, these companies don't necessarily represent the AI supercycle. If you look at most of the AI ETFs out there, you look at their top 10 holdings, it's the Mag 7. You get 35-40% of your exposure in those types of companies, kind of the mega brand consumer facing companies that frankly most people already own, either as single stocks or in other funds that they might own. And there's certainly no reason to be paying 60, 70, 80 basis points for that. So his thought process was, there's nothing out there that really captures the exposure that investors really want. So how do we do that? So his thought process was, let's dig into the supply chain. And I can walk through this in more detail later, but dig into the supply chain, understand what the segments of the supply chain are, then analyze the bill of materials. So, first of all, what is the supply chain? It's data centers and it's semiconductors. That's what really comprises the supply chain or the infrastructure of AI. That's where all the hundreds of billions of dollars are going right now in terms of all this investment that you're seeing announced constantly. So you analyze the supply chain, you overlay the bill of materials. So how much does it really cost to build an AI data center or a semiconductor infrastructure? And then you identify the companies that do that. And then you have to dig into their financials to really understand, are they getting their revenue from AI or not? And that was really the premise of it. So it's this new bill of materials concept that we've developed that really provides access to the infrastructure of artificial intelligence, which is not what other people are doing. And frankly, what it gives you is a portfolio of companies that many people never heard of most of the companies. They're companies all over the world. They're the picks and shovels. They're not exciting. Many of them, some of them are exciting. I mean, you see some of the normal names, but many of them are companies you've never heard of. And, but frankly, that's where the profits are. And that was really the premise of AIS.
Yeah, I want to dig a little bit into what you just shared there, and I'll bring in Shy as well. One of the cool things is, since we are on video here, we're actually able to go through and take a look at some of these details, some of these holdings, right? So I'm going to go ahead and just screen share for a second and pull this up inside of the window. So hopefully everyone's able to see this now. You guys able to see this on your end? Fantastic. So we can see right when we go to the website. I encourage everyone to visit Vista Shares right now and take a look through what we have here. You can see the ETF overview, the price performance, holdings, and that's what I'm going to kind of look at a couple of things here as we go down. I think the expense ratio, you kind of mentioned, is very reasonable for what you guys are doing with an actively managed portfolio here. You can see some of the pricing and the performance, and then really these holdings. And, these holdings are very actively updated, as you can see, as of 4/3/2025, updated every single day on here with the details. And like you said, it's not quite, what people might necessarily think. There's no NVIDIA up at the top here, right? There's no AMD right at the top here. People think of these names. So maybe walk us through, well, I guess before I go into that, Shy, do you have any specific questions to what Adam shared off the bat there?
No, I mean, I agree with a lot of what he's saying. I think it's great to hear him still talk about how we're in the fourth industrial revolution. People think that after seeing today's price action, narrative holds price action, that, oh, everything is dead, innovation's dead. We're about to be in a recession, the fourth industrial revolution that everyone wanted more exposure on. Nobody wants anymore. That's just so false. He mentioned earlier, they're on sale now. I agree. The future is on sale right now. It truly is. There's no, AI is not going anywhere. It's actually going to intensify. It's not slowing down. Doesn't matter what the stock price is indicating to you. The business is expanding towards adopting enterprise AI. That's inevitable. You're going to see a ton more long-term bets on compute, automation, enterprise AI. Like, the spend will not be slowing. It's going to be intensifying, and it's regardless of the macro backdrop. Like, we all know the Rose Garden announcement is obviously ruffled a few feathers on what tariffs are going to do for our economy. But I've got to say that really does not matter that much, because it doesn't matter towards business spending. Business spending enterprises cannot afford to fall behind on AI infrastructure, because guess what? They're thinking in decades. They're not thinking in months or years. And they need to make these AI related investments right now, today, in order to fulfill their 5+ year vision, 10+ year vision. So I think this is an opportunity. Like, I don't know when the bottom is in. If, like, for me, like, I have a very big cash position. I still added a bit of my favorite AI names today. Like, I'm being slow with it. I'm not being as aggressive as I usually am, because technically speaking, it looks like we're going lower. But like, if you're a long-term investor and you have a long-term time horizon, these are the opportunities you've been like not complaining about, but like hoping for over a year. Like this, like today was the biggest drop in 5 years. If you
Let's go.
exactly, like a lot of people entering this year, like, oh man, I hope we have a dead year, or like, I hope we get a dip opportunity so I can like add to these high conviction AI winners. But guess what? Every single time this correction comes, people get too scared. They sit on their hands and like they miss the opportunity. Because I can promise you guys, like 80% of the time, the market is up to the right if you zoom out enough. And AI is inevitable. It's coming, and doesn't matter if tariffs are going to be elevated and for a couple weeks, 3 or 6 months. The next 10+ years will be towards AI, and that spend is going to intensify. And that's why this ETF I love working with, because this is right up my alleyway, and it's something that isn't just fluff. Like, it's substance, and it's something that's going to be on top of everyone's radar for years and years.
And I agree. And even with this tariff information, I mean, this is kind of going out on a limb a little bit, but it might even be intensifying the importance of the AI infrastructure spend, because it's a national security issue. You think, China is going all in on this. Countries around the world are going all in, and they have to, because if they're left behind, they're going to fall behind on productivity issues, just competitiveness overall, and all the applications related to military and things like that. So, to get to the next level, to get to you get to the the models that actually create the value for consumers and for businesses, they need the compute, and the compute's simply not there. The infrastructure is not there. We need more data centers. We need more capacity. We need more powerful semiconductors, and that's going to take money.
I also want to call out, like, history doesn't repeat itself, but it often rhymes. Like, what was the last industrial revolution? It was the .com era. That bubble bursted, and you're telling me the internet didn't matter at all, even when that .com era bursted? No, it just experienced a fork in the road. Like, it was just a blip along along a massive journey of digitizing the whole economy. AI is going to follow a similar suit. So, like, people were saying, like, it was a bubble, it's gonna burst, like, blah blah blah. No, it's not. Like, all the crown jewels of that .com era, they're still holding on really strong. The Amazons, the Googles, like, all those marketplaces that are built on top of the internets, they're trillion-dollar companies. The same thing is going to happen in this AI theme. There's going to be some crown jewels that will be discovered in this thematic that, yeah, now you're getting 30 to 40% discounts on being able to add to the name. But that journey from point A to point B, that's still they're still going to get to point B. Doesn't matter what's going to happen from the Rose Garden announcement. So, like, again, look into the .com era. That was a vicious pullback. I don't think we're going to get that kind of a massive pullback, but it's a great case study on you can have a big market correction, but the theme can be still holding on really strong, and just give it time and have a long-term time horizon, and you'll probably end up in the black.
And further to that point, if you look back at that, the .com bust, the companies that busted were a lot of the consumer-facing companies, the pets.coms, right? That were just, it was very frothy, right? And we've seen some of that froth here for sure. But what was found to be extremely important over time was the infrastructure, right? Again, all the internet, all the picks and shovels to build that infrastructure so Amazon could actually succeed and Google can succeed. That's where people made the money, at least for the first, call it 10 years. And then until the consumer facing companies had enough, installed base of customers and enough power, compute power for their own purposes to, create the business models that are now making them a lot of money.
So I see a comment over there about AI. Like, why do we need AI in this predicament? I think a lot of people are forgetting how deflationary AI is by nature.
Mm-hmm.
Like, everything that we're about to experience, like, it's going to be a very cost sensitive environment. It absolutely will be. And those physical components that he's talking about that's powering AI, the GPUs, the networking, the server racks, like, they're all going to be deeply exposed to these global trade routes. And trade risks aren't just going to hurt margins, they're going to potentially slow down innovation. But I do believe that it's not just a patriotic talking point. Like, I do think that AI is going to allow companies to get much more leaner, do a lot more, a lot less. If they need to find some margin expansion opportunity on the bottom line, like, what do you think they're going to do? They're going to reduce their FTE counts, adopt investing capital towards AI type of innovation so they can still do more with less people under their umbrella. That's why it's so deflationary. And, like, you hear Kathy Wood talk about this all the time, how just deflationary, like, AI is going to be. We're not seeing it right now because we're in the exploration era. We are in the wild west of AI, where everyone's just trying to get as many tools as possible in their shed so they can figure out what kind of AI products they want to come up with under their hood. As this theme matures, like, you're going to see the deflationary component of it, and it's going to be, like, inflation won't really be a thing, to be honest, at that point. Like, I do think it's going to be severely deflationary. That isn't really underwritten right now. And I see that comment you guys had, that person Lowe's. That's why it matters right now, because guess what? American AI, and if everyone's going to be struggling financially as a business because cost of goods are going higher, consumers aren't going to be spending as much, that's the lever that a lot of enterprises will be pulling, is that AI lever to do more with less, essentially.
It's funny that I was looking at some research just a couple of days ago, and I have it in front of me. I wish I had the slide that I could put it up, but it was estimating the productivity gains from different, important, impactful events in the economy over the last, 100 years. It estimated that the internet provided a 10% productivity gain, which I would dispute that it was that low, but steam power 25%, electricity at 35%, and AI at 50% estimated. I mean, again, you could dispute the numbers. It comes from a credible research firm. I didn't make that up. So dispute the numbers all you want. It's going to your point, it's going to reduce costs across the economy in many ways.
100%. It's like, it could be as, listen, if you hate AI, you don't like technology, do you do math on pen and paper or do you use a calculator? Doesn't, you're going to use a calculator. You're going to be trying to be as efficient as possible with your time. You're trying to make it your life as easy as possible. That is AI. It is. So it doesn't matter if you hate technical advancement. You're just totally in the analog world. You're like, not the hippie, just like you want to be in touch with nature. Doesn't matter. It's going to hit you so hard that you're just not going to, you're going to work so much harder to get around it that it won't make sense anymore. And that's just the consumer angle. Enterprise angle, anecdotally, everyone is sprinting right now. They're sprinting to get as much compute as possible, to get as much AI tools as possible, treating this year as an investment year. You're hearing from all the big tech players right now. This year is an investment year for them. They're spending CapEx. Sure, it might be plateauing a bit, but they're treating this year as a sacrifice year because you're not going to see that revenue acceleration match that CapEx spend incremental increase. And that's the death nail for any shareholder, but they don't care about that because they're sick and tired of being compute constrained and energy constrained on all their AI workloads on the cloud service providers. They're sick of it. It's year 3 of this issue. So they want to get past that for the next year, maybe 2 years. Nobody really knows the end of this CapEx era. But all I can say is like you're seeing headlines from like Sam Altman saying like we're compute constrained and we're not going to have any kind of GPT innovation windows. Isn't going to be as tight as we want it. You're seeing all these NVIDIA chips being ordered from the East, like just like billions of dollars. You're seeing everyone trying to get their hands on as many NVIDIA chips as possible. That does not sound to me that we are past the peak cycle era. Like I think everyone's just trying to put their finger up in the air like, oh, I think it's going to plateau and it's over. Like that's way riskier, to be honest, than just being trend-setting and just seeing where the money's flowing. And right now the money is still flowing on AI CapEx. So like everyone's just trying to act like a genius calling a top. I think it's way riskier calling a top than just sitting back and waiting for more information to come to light and say, oh, I see now they're having decline year over year, or they're making comments here that we have enough supply at hand for the demand. Like I've seen none of that right now. So I don't know. This is typical. Like every revolution, people try to call a top and things, they get blown up a bit. And now with like like SMH being down 8% today, people like want to act like they're geniuses. Like, oh man, I told you guys, I called like the previous earnings cycle, all these big tech companies, like they were CapEx plateau. Like, oh my God. No, it's like, it's not, guys. It's not. They're evolving at best. If they're buying hardware, the IT budget will be evolving. It will go elsewhere in the ecosystem. It's not just going to be GPUs. It's not GPUs. Like Adam's, like the way he's orchestrating his ETF, it proves it's not just GPUs. Like it is a full-on ecosystem. There's always going to be hot pockets, bottlenecks that are going to have pricing powers. It's a complex system, and yeah, that's my 2 cents on that.
Yeah, I think that's why you got to take a diversified approach, unless you're a brilliant stock picker, which I am not. Taking a diversified approach to capture the entire supply chain, to have that exposure across the different segments, we think is important.
Let's talk a little bit about the approach here. So I'll pull back up for a second the holdings we could take a look at. So Adam, can you give people a little bit more context as to the actual method that's being used to pick and balance these holdings, how rapidly new things are coming into play, those type of pieces, and maybe you can hit on a few of the ones here as examples?
Sure. So, so we filed a patent actually on our methodology. So the core methodology that we use is rules-based. So that kind of forms the core of the portfolio. So we segment the AI infrastructure world into data centers and semiconductors. And we do the same analysis across both. So I'll just use data centers as an example. So we will first identify all the different components of the supply chain, ranging from power and cooling systems, servers and IT equipment, networking equipment, racking systems, storage devices, all the way down, 8 or 9 different segments. Once we've identified that, we get comfortable with that, then we will identify what the bill of materials is. So the bill of materials is, okay, we understand power and cooling systems are part of the supply chain, but how much does that segment, what is the cost of that segment in building an AI data center? And then we go down the entire supply chain and we apply the bill of materials to each segment. So for instance, using power and cooling systems, it's around 30% of the total cost of an AI data center, believe it or not. Who would think, right? Power and cooling. So we'll do that across the entire supply chain. Once we do that, then we're going to identify the companies that slot into each segment of the supply chain. So, all right, using power and cooling again, what companies are in there? You've got Vertiv, you got Trane and Schneider Electric, and these types of companies that are in power and cooling, the power and cooling business. This is where it gets complicated, and you have to really be diligent in your analysis. Just because a company is in power and cooling doesn't mean A, that they're in the data center business, and B, doesn't mean they're in the AI data center business, which is very different. So we need then to look at each company individually, dig into their financials, understand their business model, look at their pipeline of deals to see how much revenue they're actually getting from AI projects. Not that easy to find. Some companies disclose it, some don't. Sometimes they have it in publicly available news, news and information they provide. And some of it we just need to know from our expertise, which I'll explain later where that expertise comes from. Once we determine the companies that are actually generating the revenue in each part of each segment of the supply chain, let's use power and cooling example again. Let's say there's 4 companies that we've identified. Those 4 companies will have call it $100 million in AI projects specifically. Then we will market share weight them within each segment. So if one company has 50 million of the 100 million, they'll get half the allocation within that segment of the supply chain. And we do that across every segment for both the AI side, the data center side, and the semiconductor side. Then we roll that into our portfolio based on the weights that kind of fall out from that analysis. And that forms the core of the portfolio. That portfolio is then rebalanced twice a year in December and June. Just to do a traditional rebalancing of find out, other new companies that have made our revenue we have revenue thresholds, AI revenue. So have they made the thresholds? Are there companies that have fallen below them? That's a kind of a traditional rebalancing process. So that's the core of the portfolio. And that's a 100% rules-based process. We publish the rules. Everyone can look in and say, all right, why is Vertiv in the portfolio? And you can determine from the rules exactly why they're there. Once that's done, this is the key, I think, probably the most important piece, we think. In a industry like AI, as you guys know, it's moving so quickly. Everything moves so fast. The dynamics are changing. The players are changing. The deal flow is changing. Companies are winning deals. They're losing deals. They're coming out with new technologies. They're being usurped by other companies with better technologies. You have to be nimble. So as you mentioned earlier, we're an active ETF. So we're active to a rules-based process. The rules-based process is the core, what I just described. Then we have our investment committee that oversees that portfolio on a daily basis. So we have 4 people on the investment committee, and I segment them into the practitioners and kind of the portfolio construction people. Our practitioners are people that have been in the AI business since the beginning and are actively in it today. So John McNeil, I told you about him earlier. Former president of Tesla, one of the leading thought leaders in autonomous vehicles. He's involved with AI on a daily basis. Then we've got Sunny Madra. Sunny is the president of a company called Grok, one of the leading AI companies in the world. He's building data center projects all over the world. Those 2 guys know what's going on. They see what's going on. They understand the companies. They can look down our list of 80 companies and they know these companies. They know who the players are. They know who's winning deals, who's losing deals. And that's critical information that your traditional investment and analyst is really not going to know. So we think that's a competitive advantage. So their job is to look for risks and opportunities. We don't get up in the morning and start trading stocks. That's not what we do. We have our core portfolio. Their job is to identify risks and opportunities. Risks being, a XYZ company in South Korea was a leader in the racking space. I'm making this up, racking space. Now they are no longer because they've lost, their pipeline is destroyed or something. They no longer have the pipeline they used to. So that's just an example. That's a risk. An opportunity is, okay, there's a new company in, wherever in America that is now just developed a new technology that is going to dominate in the, in some segment of the IT equipment segment. So once they identify a risk or an opportunity, then it kicks over to the portfolio construction people. And that's myself and Professor Robert Whitelaw. So Professor Whitelaw was the chairman of the finance department at the NYU Stern School of Business. He was most recently the dean of the NYU Stern School of Business undergrad. He's a leading expert in portfolio construction. He's a brilliant guy. So once we find that risk or opportunity, it comes over to us, and our job is then to analyze the portfolio from a risk perspective and determine what's the best way to either take this company out of the portfolio or put a new company in. And we do that analysis, and we look at it from two perspectives. Either it's a high conviction pick for companies that are entering the portfolio. High conviction, 4% allocation. Regular conviction is a 2% allocation. And then we'll do that analysis and determine where that allocation should come from. So that's a constant iterative process that happens every day to determine, make sure our portfolio is positioned exactly how we want it to and is capturing the right exposures.
Really nice breakdown. I was sharing through some pieces of the website as Adam was talking, showing some of the team there. It's a very, very strong team, as well as some of the picks, the processes, the sectors. Shai, do you have any thoughts or questions in regards to that process that Adam outlined that they're using?
Yeah. So the biggest, not the biggest bear argument, but the biggest pushback I always get, especially in the semiconductor space, is the cyclicality risk associated with a lot of these names. A lot of the forward estimates, they can't really be fully relied on as, I don't know, the other industries that have a recurring revenue nature towards it, because CapEx, it's a gold rush. When things are going great, it goes really great. When things get sour, the lever gets pulled off. So like, how do you manage the potential, not the bear side, the cyclical weakness of a semiconductor area where, like, memory right now, like I saw Micron for you specifically, like Micron is trading at 10 times earnings. It's like disgustingly cheap right now.
Right.
But the issue is memory. People, they have a narrative that memory is a commodity. So like, does Micron deserve a premium valuation? And that's something you have to factor in also in the bottleneck of AI right now. Like, is memory as reliable? Do you need memory at this stage of AI right now as much as you did before? So I was like, how do you prepare for the cyclicality risk associated with a lot of these semiconductor names?
Yeah, I mean, look, I think from a portfolio construction perspective, it's really about it's a diversification play. I'm not smart enough to be able to choose which one of the semiconductor plays is better in any specific part of the business cycle. So we're going to take a diversified approach by looking into their pipeline and see what their revenue stream looks like. So if Micron has a robust AI revenue stream and they're a big player in, one of the segments of the supply chain, they're going to make it into the portfolio. But to your point, that's where the investment committee will come in. So if we see there's a trend, like as you're mentioning, that is going to put a damper on Micron's forward-looking prospects, that's going to be something where we put it on a watch list. And we're going to see what's going on and see what the dynamics are, and then make a determination if their allocation needs to be reduced or if they need to come out altogether. But so that would be where the active portion of the portfolio would come in.
So do you guys have a specific golden rule on size of the company that's you're allowed to have in the portfolio? Like, for example, the networking component of IT infrastructure, like we have the Broadcoms, you have the Marvells, but you also have the early disruptors like Astera Labs, which is like $10 billion market cap. Like, do you guys like kind of trend towards the safer, more mature companies that are above 50 billion, or really there is no limit on how big or how small a company is?
So yeah, in terms of market cap distribution, we're pretty much equal across large, mid, and small at this point across the portfolio, give or take a little bit. In terms of the construction of the core portfolio, we have certain constraints to make sure that it's extremely liquid. That's really our main concern, is making sure that the ETF, the portfolio, is liquid and tradable. So we won't say, so we'll cap our initial weights at a max of 4.5%. Of course, those float throughout the throughout the year. But every time a rebalance occurs, we will change that. We will go back to the 4.5% max, 0.2% min, with a $300 million market cap as the minimum. So we'll go small. But there's not that many of those in there, frankly, just because of the dynamics of the business. But we want to reach down into the cap spectrum to make sure that we're not missing any opportunities, because a company that's 300 million and all of a sudden they get on the radar, then they're 5 billion. It happens overnight.
Yeah, absolutely. Yeah, 100%. So
yeah,
I do have another question. Like, I'd consider yesterday a black swan event, to be honest. Like, I think a lot of people were anticipating 15%. Nobody thought over 50% for China, for example. Like, nobody thought that. And yeah, it might be a negotiating tactic. Who knows? We'll see. But have you internally met with your team on the policy impacts on some of the holdings in your portfolio, in your ETF, that like, oh, this is going to be heavily exposed if this bluff is actually, if this bark is really a bite, we might need to readjust this in the near term. Like, have you had those conversations yet?
we have. I mean, it's definitely too early to make any determination, to your point. But we've had those conversations, and certainly we will have more of those conversations as things roll out. I mean, my personal belief is that we are looking at a negotiating tactic to a large extent, that some of these countries are going to start coming to the table, and a lot of this is going to dissipate, I think. Hopefully.
I mean, let's hope. Yeah, I'd say let's hope. Yeah.
I'm an optimist. But yeah, I mean, certainly, look, I mean, I believe I saw something in the Times today that the semiconductor stocks were excluded from the tariffs in Taiwan.
Interesting.
Yeah. But interesting, though, Taiwan Semiconductor still got clobbered today.
Yeah.
Because I think a lot of the components that go into, building their products were not excluded. But I think it was a little bit gray, so I don't want to say that's 100% fact at this point. So yeah, I mean, I think as things shape up, we're going to need to make some decisions, because if this is a long-term issue, it's going to change the dynamic of the competitiveness of certain companies in certain countries, for sure. So we're going to have to take a look at that, and that's part of the active process. You have to be nimble. Your typical index ETF is not going to, do that, for sure.
Mm-hmm.
I want to jump us in real quick, because we've got about 25 minutes left. And by the way, amazing audience today. Appreciate everyone that's been tuning in. We have about 9,000 people have tuned in so far, which is awesome to see. Appreciate the interest in the AI Supercycle. We are going to shift gears a little bit here and talk about OMAH, which is the Vista Shares Target 15 Berkshire Select Income ETF. Again, OMAH. Go type it into your brokerage and add it to the watch list. A couple little pieces here. So this is an income product that owns BRK.B plus the top 20 holdings of Berkshire Hathaway, with a 15% income target using options. And I assume that this is part of why Jay joined onto your team.
Yeah, so we're working with Jay and his team to run the options overlay. He runs over 10 billion currently across a variety of different strategies. He's an expert. He's a guru. I was on a call today with him.
Yeah.
He knows his stuff. So, we're very fortunate to have him on the team.
Jay's awesome. I've been doing spaces with him for years. Finally got to meet him in person in Miami about 3 weeks ago.
Nice.
Yeah. So very cool guy. You just paid the first distribution this past week. It's been out for about a month, and that was 1.25% on the nose. Obviously, the goal here is getting to that 15% per year in the distributions, and then having that return of the underlying as well. Could you just explain to people that might be unfamiliar with the system and processes, what the goals are here, and why someone would be holding this and where it fits into a portfolio?
Yeah, so I'm really excited about this product. It's funny, we're talking about AIS and we're talking yin and yang, right? AIS is a long-term growth equity play. And here, this is a core equity play. This is a very different type of product. So we were looking into the income space, and my whole background is creating what I would deem as very high quality products that kind of fill gaps that are just not available in the marketplace. And we looked at the income space, try to figure out what's going on there, what's open for potential core equity. And of course, looking into that, who's the best investor in the history of the world? Warren Buffett, right? So, and then if looking at Berkshire,
right after Nancy.
Oh, of course. Yeah, well, that's true. After her, he's number one after her. But so what's interesting about Berkshire is, of course, it doesn't pay a dividend, right? So we're like, wait a minute, what if you could invest like Warren Buffett, but with income? Interesting, right? So we did our research and we, looked into the Berkshire Hathaway holdings, and it's a lot of great names in there. So we came up with a portfolio that is BRKB. Was there a top? Let me back up. We rebalance quarterly. Just to rebalance the holdings. Now, of course, Berkshire doesn't move their holdings around too much, but in terms of the weightings, it would change, and maybe there'll be a couple of inclusions or deletions based on his own weightings in his own portfolio. But BRKB is always our number one holding at 10%, and then we take their top 20 holdings below that, and we buy them in the same proportion as he owns them in Berkshire Hathaway. And then what we'll do is we use Jay and his team to create that options overlay with a 15% target per year. And we're aiming for 1.25 per month. No more, no less. We're not looking to blow the lights out. We're not looking to say, oh, guess what? We did 3% this month. That's not what this product is. This is a consistent earner. That's what it's designed to do, 1.25 per month. Look, we might miss it some months and we might have to make it up the next month. I'm not going to say that's not going to happen, but, we should be able to make that 125 pretty consistently. And we did it in our first month very easily. So the way it's used, I think there's really two distinct use cases. The first is as part of your core equity exposure. If you like Berkshire or you believe in Warren Buffett, why not buy this as your core part of your core equity exposure? Or if you own Berkshire Hathaway, BRKB or A, it doesn't pay a dividend, carve a little bit off, buy this, get similar exposure, but create a synthetic dividend. So we're getting a lot of traction on that as well. It's very interesting. And it wasn't even necessarily part of what I was thinking when we developed the product, but it became apparent that it's an important piece. So we launched it about tomorrow will be a month. And we didn't even start talking about the product really until this week, because we wanted to wait until the income came out. And it's exploding. It's really interesting to see. It's really resonated with investors. And, we've done a little social media, not much up until this point. And we had 5 creation units today. I mean, again, haven't even really sold it yet. So that's not in the assets yet. We'll be above 10 million by tomorrow or Monday when those clear. And, we think it's going to be a really interesting product for investors.
Yeah, it's super interesting to me. One question which I always get, which maybe you can address for people, is because I've seen a few products, actually not one on Berkshire, which I'm glad to see because Berkshire has been doing so well this year. But people look at the price differences, right? So they look at Berkshire and they say, hey, past month, it's up 6.17. They'll look at, the product we're discussing here, right, down 4.25. What's causing that discrepancy that people are seeing in actual price movement?
So we're not going to perform like BRKB in all market conditions for sure, because remember, we're only doing the top 20 holdings, number one.
Right.
So Berkshire Hathaway has a lot more than that. So that their long tail of holdings has been driving their performance over the last month. We have a bunch of financials. We have Apple in our top 20 because that's what he has. Now we saw Apple today down 9. We saw the banks down 9, 10, Citibank, Bank of America. We've got Visa and MasterCard and VeriSign. And so it's a lot of financial services companies, which frankly might be good in a tariff environment because they don't have as much to deal with on the tariff side, which is nice as an industry. But yeah, so I mean, typically we're not going to keep up when Berkshire is ripping to the upside. We're just not. We're going to get over a cycle, call it 70% of the upside, maybe 75. That's probably the right number to expect over time, not in a week or a month. And then on the downside, this is not a hedged product by design, but just by the nature of the options overlay, probably a little downside protection, perhaps over a cycle. Typically we should perform really well when Berkshire is kind of, doing okay or down. And then we were not going to keep up on the upside for sure.
Got it. Makes sense. And it's good for people to understand this because it's just a question I get all the time. Shai, when you look at a product like this, what's your thoughts?
My thoughts. Yeah, I mean, my thoughts is strategy and diversification, because the point of these are, I don't know which name to pick. I want to be protected, have the most amount of reward to risk ratio, and I also want it to be active. Like I want someone to be like, not working for me, but like actively on the screens when I can't be on the screens because of my daytime job or whatever it might be, family. Like, so I like to see someone who, like an ETF that is actively managed, so that they are got their finger on the pulse of what's the latest and greatest and like where the wind is blowing. And I won't have to worry that about them be pulling a Powell where they overstay the welcome and you just have no, like they should have pivoted way long ago. Like you don't have to worry about that with these ETFs. That's the beauty of it. So I wonder if you're gonna have any kind of more ETFs down the pipeline with how great these first two ones that you just called out. Like I also love the names of them. So like it's a great, clever name. And maybe one for quantum or space robotics.
Maybe we'll have to see. But yeah, I mean, yeah. So if you think about what we're doing, we have two families of products: the super cycle products and the income products, and we will be going deeper into those spaces for sure. And to your point about active management, I was talking to Jay today. They did 50 options trades today. 50. It's a very volatile period. They were making sure they were positioned properly. So you're very active on that side, and you have to be to make sure that you have a good product. So we think that's important. One other thing that's important is that we should be return on capital for this product. Our first 19A came out just yesterday, which we just posted to the website. I think it was 96% return on capital. So that's an important tax benefit of this product over others as well. So, we're pretty eager about this. We have several income products behind this that we think will be interesting once we get more traction here. And and on the super cycle side, we've got some things in the hopper as well.
Yeah, we could take a look real quick just at the web page itself. Reasons to consider. We've run through some of these items. Pretty easy how to invest. These are all on Robinhood and all other brokerages. Very easy to find. Really, the breakdown on everything. The expense ratio is still keeping that under 1%, which is nice to see. You've got your distributions, and you'll be able to look for when those are going to be coming out. And then, of course, those holdings as well. And like you said, right, when you have, a 10% to Berkshire, but then you also have 8% to Apple and these companies that got a little bit slaughtered today, that's going to be, some of what just happens and continues to go about there. So I think that those are pretty important things to touch on. And I like how you balance it out as, here is where each one of these fits in your portfolio, and they're very different. What do you see as your kind of guiding light as a firm? Is there, you find all of your ETFs are going to have some type of connection? Because I'm sure you're going to, keep coming out with more products. Where's that vision?
Yeah, I mean, we're not going to have 100 products. I mean, we're going to really focus on what we believe to be high quality products that solve problems. That is it. We have a third family of products that we're going to be coming out with. So for the foreseeable future, it will be our super cycle kind of disruptive technology focused products that use that bill of materials, patent pending process, investment process. We have one that's already been approved by the SEC for around electrification, power generation, which is another important piece of the AI puzzle. And we'll be looking at others there. And then on the income side, we have 4 other products on the shelf, and then we're coming out with this other family. So, we'll probably stick with that. The three families work together for very different purposes. And, we're looking basically to bring out products that give investors confidence in, regardless of what opportunities are in the market at that point. We want to have something for them, whatever is happening. So up markets, down markets, sideways markets. You need income, you want growth. You're looking to do a little trading. We want to have that available, but do it in an institutional way. My whole background is institutional quality products, and everything we do is with the mind of an institution. Make sure they're designed properly and transparent in terms of construction.
Got it. I'm going to throw in, is there anything else you want to cover on OMH, or do you mind if I bring us back to AIS?
No, that's fine. That's great.
Okay. So let me throw in something there. There's a lot of companies now that are really making significant investments into AI infrastructure. Obviously, there's big ones like Meta. There's ones that are just recently IPO'd like CoreWeave. You have private companies like XAI, right? And they're all making significant investments, specifically into infrastructure, which is where we're targeting here. I wanted to get your thoughts on how ETF investors, kind of access the potential of those type of firms relative to an OpenAI or an Oracle, who are also making a lot of investments potentially into some different areas.
How to access the consumer-facing apps?
Yeah, how they can access the potential of those firms.
It's a good question. I mean, we are staying away from this consumer facing segment right now because we just don't know. We just don't know who the winners are going to be, and more importantly, even if you say I know that Meta is going to be the winner or a winner, when is that revenue going to hit the bottom line or the income? Where's the incremental income, and how long is it going to take to boost profit margins? We just don't know that. So we just again come back to the infrastructure for now. The infrastructure is where the profits are. Now, we do have the ability in our rule book to bring a new supply chain in for the consumer facing applications. So when we believe that it's time to start getting access to that, we will bring that in as a third or a third leg of the stool to ensure that, our investors get, appropriate exposure to that as well.
Got it. One other question, just kind of given the scale of investments into AI computing, how do you project AI and semiconductor ETFs in general, including IIS, just to perform over the next 5 to 10 years?
I think we're in a renaissance for these type of these companies. I mean, I really do. Again, just coming back to the dollars being spent. I mean, can I tell you who the winners are going to be in every segment? I cannot. And I don't claim to be able to do that. So that's why we think a diversified approach is the most appropriate way for most investors. So, but again, it's coming back to AI will never happen to the extent that it needs to or should happen unless we have the capacity in the data centers and the increasing power on the semiconductor side. Every leap on the semiconductor side is going to open up a whole new wave of growth and profits for the semiconductor companies, right? So it's an exciting time to be in that business for sure. I mean, the dollars are flowing. And again, coming back to just the arms race globally around this whole thing, it's not just companies like Meta and Google. I think it really comes down to the countries themselves. I mean, the US, China, the EU, they all need to win or at least be in the game. And the only way they're going to be in the game is if they spend hundreds and hundreds of billions of dollars to stay in the game. And even then, who knows who's going to be the winner? But it's an interesting way. It's going to be interesting to see it and see how it plays out.
Yeah, I agree with that. Shai, wanted to turn it back to you. We've got about 10 minutes left here. We'll maybe do about 5-6 minutes more of questions, and then we'll do some wrap up. Anything else on your mind when it comes to this area, or maybe just any general thoughts that you would share with retail as they start to research AIS?
Yeah. So I think AIS, I think AI specifically as well as AIS, because it's a great vehicle to capture that thematic. I think it's business as usual. I really do think people aren't just going to be pausing on the fourth industrial revolution of our lifetime because of something our president said that people are underwriting and maybe as it's a tactic. Like, you're not just going to all of a sudden pause on everything. That doesn't happen. Like, those decisions take quarters to make. It doesn't happen in a matter of days, weeks. So my question for you, Adam, though, is I think it's a bark. It's not a bite. How long do you think this can go on where we believe it's a bark, but then it turns to a bite? Like, do you think if 3 months goes on, it's like, okay, this is going to be the first man-made recession since World War II? Or do you think it's going to be like this upcoming earnings cycle where one specific name that we think like, oh, this is going to impact hard on tariffs, and they actually deliver good results? So maybe it was just FUD. We're not seeing it in the numbers yet. It's like, what's your kind of tell in the next couple months?
Yeah, God, I'm going to be an optimist. I think the vast majority of the situations with individual countries are going to resolve themselves over the next 30, 60, 90 days on the outside. And we'll start, I'm guessing we'll start seeing some information coming in, and even in a week, of certain countries, saying, uncle, right? I don't want any part of this. I'll bring it down. You bring it down, type of thing. I think a lot of that's going to happen. There's going to be a lot of bluster. I mean, we saw France come out and start blustering today. Certainly China is going to be the sticking point. That's going to be the big one. I don't think that's resolved in 90 days. I think that one's going to be going on for a little while after that. But I think most of the countries will fall into line. There'll be a negotiated settlement. And I don't think we're going to get everything we want, and they certainly aren't. And it's going to be somewhere in the middle. But I think it's going to be there's going to be a lot of momentum around announcements coming over the next, several weeks. Is my guess. Hope.
That's exactly what you want to hear. Just headlines that are just going to drive the market up or down 2%, maybe some circuit breaks. Yeah, I mean, I gotta say, I smiled today. Like my portfolio was down 6 or 7% today. I was smiling because like it's getting closer to the ad levels that I've been dreaming of for like over a year, because we're in it for the long term. Like we know the AI has a long runway. It has a lot of legs. It's not a fleeting moment. It's a structural change that's going to be permanent. And having that mentality, these are kind of environments like that give you the conviction to add certain high quality names in the AI space that aren't going anywhere. So, yeah, your ETF specifically, like the holdings in there, I'm confident they're going to be here in 5 years. I'm very confident those companies will be here in 5 years, and that's why this environment, like, you don't add to those speculative names because they, yeah, there might be a 10xer on this dip over here, but odds are like they actually might not be around in a couple years. And this kind of macro driven pullback, it doesn't happen that often. Like it feels like maybe it does, but this is the biggest sell off since 2020, once in 5 years. We had that yen carry trade crisis, which was so short lived. It was a V shape within a week. Like this is the kind of macro driven pullback that is policy driven, which can be turned off on a switch if everyone essentially waves the white flag to Trump, and then business as usual. So I think plan accordingly. Yeah.
Yeah, I mean, the froth had to come out of the market, at least in the AI market, and I agree. I view it as a great thing because it was getting pretty, tipsy.
Totally.
A lot of those valuations, and it was hard even to go to talking to investors about it because, I felt like some of the valuations were extended. What do I know though, right? I'm not an expert on all these valuations of all these companies, but the fundamentals haven't changed. It's the narrative that's changed, or the global macro narrative has changed. So if when the fundamentals change, then I think everyone's view should change, but that has not changed. The investments going in, the promises there, the productivity gains are there, the requirements for the infrastructure are there. And I think that's where we sit right now.
Yeah,
absolutely.
Very well put. Agree with both of you. I think that there's a long-term vision here. Certainly, if you need the money in the next year or two, it's tough to go through market downturns like this. But if you can have a little bit of that longer term, my greatest buys all came in COVID, right? That's where all my best cost basis originate from. I wouldn't say that we've necessarily even pulled back that far right now on most of these, right? But some of them have retraced 30, 40%. Could be interesting to see that go a little bit further on some of these names. Highly recommend. People like Shy are awesome on social media to follow because he's consistently breaking it down. I think there's a lot of fear when it comes to this stuff. Adam, how do you think people can, learn to understand their emotions when it comes to investing in times like these?
Yeah, I mean, that's always the toughest, right? I mean, people they're when there's euphoria, that's when everyone wants to jump in and they're buying too high, and when there's fear, everyone is scared and doesn't want to. You got to reverse that somehow. You got to just be very mature is not the right word. Just you need to look at the market as an long-term opportunity, and if you like a company or a sector, if it pulls back and the fundamentals haven't changed, that's when you want to go into it. I mean, I firmly believe that. I followed that philosophy my whole life. Not going to say I always did it right. I mean, I bought stuff, 2 months ago that, was too high, so, everyone does it, but if you can have the discipline to, buy low, and when everyone's scared, that's when you want to get in.
100%. Adam, it's been a real pleasure having you on here tonight, educating the audience. About almost 11,500 people tuned into this, which was great to see. We get some amazing audiences on these live streams. I hope everyone enjoyed. Shy, I'm going to come to you first for any other thoughts, anything else you want to share on these ETFs and the AI Supercycle?
Yeah, I mean, the gut feeling many of you guys have right now in this pullback, I think highlights stock picking isn't for 99% of people, 90+%. 23, 24, those are years where, let's be honest, like it didn't take a rocket scientist or like someone with a strong stomach to be able with be part of the market those 2 years. This year, it's choppy and it's ugly. The market is meant to be choppy, and it's meant for retailer investors not to succeed in. 23 and 24 were kind of a gift where tech went up like 70-80% in that span. Like, that's incredible. It's unsustainable, but it's incredible. But I think now people are realizing how difficult timing the market is, how difficult finding the relative strength in stocks is, finding which companies have a defensible advantage, a competitive moat. All these parts of the calculus of being an investor is hyper difficult when things aren't just up to the right. When trends are breaking and you have to be stuck on a screen to monitor what's happening, but you have the luxury of that time because you're working a 9 to 5 job. You're doing so many things in your life where before you're just like, you could pick a stock and like not worry being down 10-18% in one day. Like, Apple's down 10% today. Amazon's down 9% today. That has not happened since the COVID drop. Like, this is unprecedented. And it's not just like the speculative names, it's across the board. And people have pits in their stomach. And if you're losing sleep this week, the past couple weeks, this is not for you. And that's totally fine. There's so many vehicles to capture secular growth themes that you want exposure in, like the ETFs we were talking about today, that you can still capitalize and outperform the market because this theme is going to fulfill whatever thesis you had without having to do all the nitty gritty stuff, the hours of R&D, the timing of the market. Like, that's hard stuff. I love it. I wake up at 3:30 every morning with no alarm clock because I love it so much.
Yeah.
It's in my DNA, so I can do that. And I commit the 40 to 60 hours a week in doing so, being in tune to the market and doing the R&D. But that's not a lot of folks. So like, that's why I have to be very open-minded where this year's a new chapter. It's probably not going to be anytime soon like 23 and 24, and you have to dictate your future behavior on the new characteristics of the market without having to remind yourself what historically has happened, because that will burn you and probably has burned a lot of you guys this year.
That's great synopsis. I think for me, it's really even, shorter. It's just be diversified and have a long-term perspective. That's it. I mean, from somebody who does not know how to time markets and always, buys high and sells low. If I'm doing my own thing, it's having a disciplined process. That's why everything we do is rules-based in the core. We're not cowboys and cowgirls going out there and flinging around stocks and buying, selling, even though we're active. We have a rules-based, disciplined core investment strategy with the oversight of experts to provide some semblance of, being able to identify those risks and opportunities. And that, for me, that's the way I've always liked to invest.
Beautiful. I think you both hit the nail on the head. This is a great way to start your due diligence, listening to us here. But of course, you got to take it to that next level, especially in times like this. You want to make sure that you are really understanding what you're purchasing. I would direct everyone, I've ran it a couple of times on the bottom here, but you can go check out vistashares.com to learn more about AIS and OMAH. Please understand, of course, the content that we do is for informational purposes and educational purposes. We don't make recommendations or endorsements of specific ETFs or strategies. If you feel the need to consult a licensed financial advisor, please do so. And as always, we'll see you on the next one. Take care, everybody. Appreciate you all tuning in.